Hi everyone, welcome to Unit 1 of Global Financial Reporting and Analysis. This week is about setting up the big picture. By the end of the unit, I want you to be confident in answering three questions. First, why do reporting and disclosure rules differ across countries? The short answer is institutions and incentives. Different economies prioritise different users and uses of financial reports. Some systems evolve to support shareholders and deep capital markets, so we see transparency, fair value, and lots of disclosure. Others evolve to protect creditors and banks, more conservative recognition, greater emphasis on cash coverage, and solvency. The rules reflect the audience they're written for. Second, how do they differ in practice? Think about the framing. In equity-oriented systems, the spotlight is on earnings, ROE, and valuation. Investors want decision-useful information to price risk and growth. In credit-oriented systems, the lens is on cash flow, leverage, and covenant compliance. Lenders want assurances they'll be repaid. You'll see this show up in recognition choices, measurement, fair value versus historical cost, and the sheer depth of required disclosures. Same underlying business, different emphasis, and sometimes different numbers. Third, why does all this matter for you? Because accounting doesn't just report reality, it shapes it. The numbers influence behaviour in three powerful ways. First, real effects. When we measure something, managers respond. Change the accounting, and you often change the operating and financing decisions. We've also got price effects. Markets react to what's reported and to how results compare with expectations. The timing and classification of earnings can move billions in market value. Also, we have contracting effects. Debt covenants, executive pay, and supply chain terms are written on accounting metrics. Miss a covenant and the consequences are immediate. Across borders, those effects interact with different rule books. That's why identical strategies can look safer, riskier, or more profitable depending on where you list, borrow, or operate. Now, two themes will run through the whole course to make this practical. First, data visualization and storytelling. Good analysis is only half of the job. The other half is getting busy decision makers to care. We'll practice turning a messy table into a single chart that answers a business question and crafting a three-part story: hook, insight, and action. You use Excel and AI tools to draft, refine, and pressure test your visuals and your narrative. Second, hands-on, employer-aligned practice. In our seminars, we're going to work with current company disclosures and market data, and we'll look at how the same economic event can be reported differently under different systems, and what that means for pricing, for contracts, and business decisions. Expect short group tasks, quick debriefs, and specific feedback on how to tighten your analysis and your story. So what to do before class? Have a look at the Unit 1 notes, which are up on Noodle. Notice where the rules emphasise different users, and jot down one question you'd ask if you're a lender and one if you're an equity analyst. Bring those along to the seminar. That's it for this week's overview. In class, we'll take these ideas and run them through some real examples so you can see how the rulebook you're in changes the decisions that you make and the story you tell. See you in Seminar 1.